Good morning, everybody. Welcome to another Daily Mark Report brought to you by Mike Bjork. Today is Friday, March 27th. Hope you guys are having a wonderful day today. Hope you guys have some great upcoming plans, maybe some great movies since we are under quarantine these days. Maybe you got some great family activities designed for the weekend. However you guys do it, I hope you guys at least kind of make the best of it. Let's jump ahead here. We do got a few items here on the economic calendar here today, and we'll start off with the personal income for the month of February. Of course, like we have been saying for last week or two, a lot of this data we see that are back in January, February, even parts of March, aren't going to be relevant due to the sudden impact we've had here in March due to the coronavirus on the economy. So a lot of this will be kind of irrelevant, and this would be kind of one here too. We had personal income uh, for the month of February, so January was up 0.6%. Forecast was for 0.4% in February. However, it went up 0.6%. So obviously, the economy was looking pretty good at that point. People were making more money. Uh, Even spending was kind of dwindling a little bit here. As you can see here, it was consumer spending in January was at 0.2%. Forecast for the same rate at 0.2%, and it increased 0.2% in February. So people were making a little more money, but they weren't, however, spending as much as people were thinking. Uh, Now we get into what we call the personal consumption expenditure. This is the Fed's favorite gauge for inflation index. So we have two indexes for the consumer side. We have the PCE and we also have the CPI. But the Fed really looks at the personal consumption expenditure, mostly at the core PCE, which we'll touch on here in a second here. Back in January, it rose month over month 0.1%. Forecast was supposed to be at that same pace at 0.1%, and it came in at the same pace at 0.1%. Its year over year remained unchanged at 1.8%. Now, when you strip out the food and energy, which are variables that we cannot control, that's what we get gives us the core PC. Also, they call it core inflation. So we had a 0.2% back in January. Forecast was again maintained that same pace at 0.2%, and it came in at that same pace of 0.2%. However, its year over year went from 1.7% up to 1.8%. Still under the mark that the Fed like it to be. The Fed likes it at 2%. However, we are still under that, and this could actually drop a bit now that we're going into this new market we have with the coronavirus, and as there's really no inflationary pressures as of yet. Now, later it could with this $2 trillion package coming in here that's really trying to jumpstart things. It could spike, and we could see a backlash on that. But there's also even concern that we could go into the reverse one, deflation. Excuse me, my mind was going blank there for a second. Um, so to kind of move on here, we also got consumer sentiment for the month of March, as one would expect with the current environment. Initial reading came in at 95.9. Forecast is supposed to dip down to 89. It came in at 89.1. So of course, consumers aren't feeling as rosy as before, the coronavirus. So things have kind of dipped down a bit since the coronavirus, especially after considering we had over 3 million people apply for unemployment last week, and that could continue to rise as we go forward here. Let's jump ahead here to the headline news. Stocks are down this morning a bit. There's concerns that the coronavirus cases in the U.S. could be exceeding that of what was in China, and that's what's kind of a bit alarming to investors right now. And again, that's going to affect overall economy. The House is supposed to be voting on the stimulus package today. Pelosi said that they will get that through. There's been some concerns that there might be a few dissidents in there that could blow it up and may not make the passage, as I believe they need a unanimous decision. However, Pelosi sounds like she's confident that it will go through. So fingers crossed that we get this moving package. It's not a perfect plan, but however, none of these things are ever perfect, and hopefully we can get some help out to those who really need the assistance in this. Let's see how this is affecting the bond market. Bond market right now is up about 77 basis points. It's taking quite a toll here. We Unfortunately, this is good. This would be under good news under regular circumstances, but however, and again, I meant to do a video yesterday. It's just unfortunately, we had some strong winds that coming in yesterday and kind of stirred up things and kind of wreaked havoc on my allergies, and it was a little difficult for me to do any videos yesterday. But the big thing about this is that, even though the bond market is rising, typically the mortgage rates will go down. But because of this is killing the lenders on they have what they call margin calls, and so because of that, they're trying to get through this huge influx of loans, and they're unable to because they constantly with the hedges, their line of credits are asking for margin calls, the margin calls, and that's kind of wreaking havoc. So as a result, a lot of these are bottlenecked and not able to get through it. What's propping these up is that the Fed every day this week is buying a bunch of mortgage-backed securities and treasuries, which has helped boosting it. And unfortunately, they are inadvertently hurting the housing market as a result of that instead of helping it. So, especially after the big influx of those refinance loans that we had back in March. So as a result, we are getting a lot of investors pulling back, big companies that would be these investments, like the back end of things, so like PIMCO, those people that were out there buying a lot of these mortgage-backed securities, like your non-QM loans, which basically are almost impossible to find right now. Jumbo loans now are the same result, that a lot of lenders are not offering jumbos right now. We have a couple that are doing it, but for how long, I can't say, because at some point they'll run out of money and won't be able to continue those. So if you're in those type of transactions, be careful, because at any time they could be pulling back on that, as they won't be able to probably fund those loans. And then we got conforming and the government loans. So government loans, those people are having a hard time with their servicers, and as a result, they are having they're having to increase a lot of their FICO scores. They're having to lower their what they call uh, and also lowering their debt to income ratio. So they're really being tight on those things as well. Conforming, they're kind of looking at the same thing. So I'll try to get that video out later today. I'll try to figure out what kind of format, how to do it, but I have an idea, and I'll try to get that out later today. Uh, as my allergies are feeling a little bit better today, so I'll try to get that out today. I apologize for not getting it out to you sooner. So, anyways, to get back to this, normally this would be circumstances where we would have better rates, but unfortunately, this is kind of squeezing the markets again, because of the margin calls, that's putting the more pressure on mortgage on lenders due to those margin calls, and if anything, it's actually raising rates in a way that they can't really function right now. So meanwhile, these loans are kind of sitting there idle. All right, so yields, they've fallen a bit further down. As you can see here, we're down to about zero point 0.7. I think it's about zero point 0.7 right now, or 7.1 in that range right now. And again, this is pushing the yields even further down a little bit today. All right, so again, rates should be a little bit better today if you look at the technical, looking at the charts. But however, again, with the margin calls putting more pressure on lenders, they may not be pricing that in their rate sheets. So just so that you're aware of it. And then try to stay tuned. I'll try to get that out to you today. A friend of mine wrote actually a pretty good discussion on that, and I'll add my 2 cents to it as well. So I might just do a video on that, on how he kind of simplified it and kind of explaining what was going on with the markets. So I'll try to get that out there as well. And I just might kind of put that on there and just kind of read through it so that you guys can kind of see it for yourselves. But however, if you guys are in California, you guys are looking to buy or refinance, please feel free to reach out. We'd love to be able to help you guys out, especially through these trying times right now. Navigate through these waters. We work with a variety of investors. So if one investor's not offering some product, we have other investors that might be offering it, whether it's pricing or whether it's a loan program that's available. We might have that for you guys. So we are a great outfit for this type of scenario, and it helps out for providing different solutions. We work with a lot of people from trying to help them with their liquidity to their college planning to different retirement to different phases they want to try to work with, and we try to fit these loan programs to help them create a plan and get those into their scenarios. So you guys have a great rest of your day. Thanks so much for watching. I hope you guys get through this okay and enjoy your weekend as much as you can. And we'll see you guys on at least worst case scenario Monday's video if I can't get the video out today. But I'll do my best to get that out for you guys. You guys have a great rest of your day. Thanks for watching.